Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about Rain Industries, a very interesting share that has come back by about 70% from the lows. Let's understand whether it is a good share to buy or whether you should avoid it. So, let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about Rain Industries, here's a small request that kindly support me on Patreon. And once you do that, it will help me grow the channel. It will help you also ask me questions on stocks as well as markets and companies. The Patreon membership begins at $2 per month and it goes up to around $10 per month, where you will be able to view my portfolio, watch list, and also ask one line questions on a daily basis. For detailed market or company analysis, kindly directly email me, and if you have a number of stocks with you, I'll definitely help you with that as well. Now about Rain Industries, the company produces petroleum coke, chemicals, and cement. And major business of theirs is in production of CPC and CTP products, which is more or less related to coke and carbon black. Other products are Portland cements, resins, and aromatic chemicals that they are making. Brand of Priya cement in South India is also related to Rain Industries, and Priya Cement also sells a lot in that region. If you look at the financials of the company, then this quarter has been pretty good, with sales even dropping by around 9%, yet profit has grown by around 22%, which has been quite good, and that shows higher operating efficiency or operational efficiency. The debt is pretty high, and that is a cause for concern. In that regard, a low promoter and institutional holding is also not that augurs well. The return on equity currently stands at 20%, whereas the operating profit margin is at 19%, but is improving at the moment. If you look at the performance of the stock, then the stock has been relentlessly falling since 2018, and from Jan 2018 till just recently till March, the stock was down around 90%, 92% from the highs. It is currently up 50-55% from those lows of 45 rupees. 45 rupees was the lows made by Rain Industries during the end of March, and currently the price is around 79. It has surged around 70%, actually 60-70% from those lows. uh, Profits have declined sharply, but over the last quarter has been pretty good, so that has to be taken into account, and this is why the stock has surged from those 50 rupee level, because the expectation was not that the company would come out with such good profit numbers. Business has been impacted by high cost and low demand globally, so demand of its CTP and CPC products have declined sharply, and that has led to the business having lower revenue going over the last 1.5 years. But last quarter has been a turnaround of sorts. So what has changed? Profit has increased this quarter. So this has changed. So increased by around 20 odd percent. The sales have reduced, but higher profitability show greater operational efficiency. So clearly, because sales have decreased, there is high debt, etc. But yet the net profit numbers have increased. That clearly shows that they are saving costs somewhere, and eventually having higher margins. EBITDA, or earning before interest, taxes, depreciation, and amortization, has increased by around 24%, and margins have improved. Demand for CPC and CPT products have reduced over the years, but it could well be that over the next few months, that demand might just come back, and the profit numbers show the right direction, because you have margins increasing. Heavy debt is causing high interest costs for the company, and if that debt is reduced even by 20-30%, then there will be a sharp increase in profitability even going forward. Currently the stock is trading at around 12 13 times earnings, which is not very expensive, but then the numbers have to continue to come, which has not come over the last 7 8 quarters. So let's see if the numbers do come in for the next couple of quarters as well. Raw material prices have been increasing, and that is also a cause for concern, with the oil prices now steadily going up globally. The stock might feel pressure going forward, or the numbers could be under pressure again. So basically what is happening is that the numbers might not be consistent, and that is the fear the investors have, and that is why the stock is down so much. If we look at the technicals of the stock, then currently it has lost 90% value in 2.5 years, but has seen decline relentlessly from Jan 2018. But what has happened is, over the last 3 months or so, the stock has risen around 70% from the lows of around 945 levels, and that is perhaps one of the, you can say, lowest lows that the company would make, and there could be a surge coming forward in the next 6 months or so. It is in an upswing at the moment, and a major up move is expected above 90, which is the 200 DMA. So probably if you're looking for a technical bounce back, or for a short term play, then wait for the stock to get past 90 and then get into the stock with the stop loss at 80 or so. Currently, if somebody wants to get into the stock, then probably 60 would be a viable level to have a stop loss at, and then trade. I think there could be a move downwards as well, because the stock has already surged so much. So one needs to understand that while getting into the stock after the stock has moved up so much, may see 125 levels in a few weeks or months time. uh, just technically speaking, once 90-95 levels is crossed, we could see 125 levels. The stock does move very quickly up and down, so you need to take that into consideration. It is extremely volatile. A stop loss to be maintained at around 60 levels. So what needs to be done? I think if you don't have it, then avoid it, because I don't see the company giving consistent profitability over 1 year, 2 year period. Probably next quarter could end up being good, and then again there could be surge in raw material prices, surge in, you can say, expenses, or anything, or lower demand might curve the profitability, and the profits number could be in a range. Plus, high debt is a cause for concern, and I would definitely avoid any companies with high debt, no matter how good that company would be. With low debt companies, the thing is that even in difficult situations, they come out with decent results. Remember, it is a commodity business. The kind of products Coke or Pepco and etc., CPC, CTP that they make, they all are related to commodity businesses, and that's why I avoid that. All related to also oil prices, which needs to be curtailed in order for the company to really do well. Then there are sanctions by countries as well. So there are sanctions posed by US on Russia. There are sanctions on some of the raw material that they use for the production of CTP and CPC. Sanctions made by India currently. So the prices, or you can say, there are taxes levied, and the prices for those raw materials that they require importing that raw material is a cost for them. So all these reasons is why I would not buy into the stock, even if the stock may just double from here. But it may be past its best of 450, so you need to understand that. Look for massive up moves to slowly exit if you have it at 125 130, and look for pure consumption play. There are many consumption stocks that are available for you to buy, and these are weak stocks, and avoid these weak stocks. So this was a video on Rain Industries. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.